Welcome back to the BlackLetter Podcast. We set out to create an entertaining and exciting podcast about law and business. BlackLetter, the name, comes from the Gothic typeset. Over time, BlackLetter became the only font that English law books were printed in. It made it harder for kind of the common person to understand what the English law books said. BlackLetter came to represent something that was law, that was set in stone, that was sort of old and a well-settled fundamental principle of law. We're here to demystify black-letter law. We're here to demystify things that happen in business and law and where those two meet. And I hope you have fun listening. Welcome back to another episode of the BlackLetter Podcast. With me, I've got a team from SD Capital, Tom Springer and Stuart Lawson, and my law partner, Wright Lewis. Tom and Stuart work with clients to help position themselves for sale or acquisition, or to help find a sale or acquisition candidate. From what I understand, they're working with one of my clients right now, and that client has been duly impressed. So we thought we'd have them on the show and talk about what they do and how it works and what their concerns are, because the political landscape's a crazy thing. And Stuart, I did notice you were at Arthur Andersen for 10 years. So I have to ask, because my father was there for like 40 years, and he was the managing partner of the Global Tax Group until he retired. And I just have to ask if you happen to know him. I don't know if you did. He was in the Chicago World Headquarters office in Geneva.
But not off the top of my head, I didn't know him, but I will tell you that if he worked for Anderson, I'm sure he was a top flight individual. So,
yeah, well, he was there he was one of the rare cases. He was there from 1968 until 2001, I think. So he was at Anderson SC when the company split, and they offered him the job of CFO of Arthur Andersen accounting side, and he retired, which is probably wise. And Ron, and some shredding stuff happened, as we know. Anyway, interesting stuff. So bygone. So let's talk about what you guys do. So tell me, Tom and Stuart, whoever wants to, what does SD Capital do?
So SD Capital is a middle market value advisory and M&A transaction advisory firm. We're pretty unique in the marketplace in that we are former owner operators. So we empathize with an owner from an owner's shoes. We've actually built and sold our own companies. So it's not the traditional investment bank perspective. In addition to that, we also had come from, working in the private equity space. We understand what it's like to sit across the table and, analyze a company as to, a deal thesis or synergy targets, so we can anticipate, impairment of value or discounting, which then we turn around and help the owner stave off those strategies from the buyers. We work well in advance of a transaction, typically 18 to 24 months, so we can make material change to increase enterprise value pre-transaction. And also, I would say that we're very creative in monetizing or identifying ways to monetize and work through those strategies to help owners monetize value outside of a traditional third-party sale. So that's a pretty unique perspective in the marketplace.
Okay, so the marketplace that we're talking about for listeners is that essentially companies that are looking to sell themselves, you're getting them ready for sale, and you work with them 18 to 1.5 to 2 years in advance of that sale in order to make the company more valuable. Is that kind of a nutshell, non-technical description of what you do?
Yeah, you captured it really well, Tom.
Okay.
So the other thing we do, Tom, is we don't necessarily always end up with a pure sale of the business. There's a lot of variations that we look at for owners to potentially monetize or take some chips off the table. So it doesn't necessarily have to result in 100% sale of the business. There could be a non-sale, or there could be intermediate steps as well that could be an option for a particular owner based on their particular situation.
Okay. So in other words, if I'm a 100% owner and I'd like to be a 50% owner or a 60% owner and take some risk off the table and take some capital out, you also help with figuring out ways to do that, effective ways to do that.
Exactly.
Okay. And how do you work with people like my law partner, Wright, who does M&A work as an attorney? How do you work with attorneys to do this? What's kind of the roles of the two of you?
Yeah, no, it's critical that the partnership's critical to us. When we are looking to position a company for a transaction, what's really important is to understand the needs and desired outcome from that owner outside of economic consideration. So does the owner want to stay with the buyer? Do they want to run for the hills and cash out? If, for example, they want to stay with a buyer, get a second bite at the apple, it's really important that we navigate through a multi-step process, such as an IOI to an LOI, so we can shape a deal early and find the right buyers who are willing to entertain the deal structure that is most appropriate for that outcome. So, for example, if you have an owner that says, I wouldn't mind, I'm open to the idea of going with a buyer, let's say a private equity or strategic, getting a second bite at the apple, we'd shape the deal structure working in partnership with Wright and the team to say, look, here's the structure of the deal we're looking for. If you're willing to entertain this type of structure, please come to the table. If not, it probably doesn't make sense because the owner most likely would not be interested in what you would provide, as an example.
So do you find these private equity companies or venture capital companies or whoever they are, mezz funding, do you go out and find the source of capital for companies as well?
Yeah, absolutely. I mean, if that's part of the strategy, if they're looking to source capital, we can find the right partners, whether it's minority, majority, control, non-control positions.
Okay. And what about, I know a lot of these deals sometimes involve putting multiple companies together as a strategy that are maybe in the same space or have some synergy, whether it's in the specific milieu like cybersecurity or government contracts generally or something like that. Do you put companies together as well? Or is it a single company focus?
No, it's all the above. And Stu, maybe you want to jump in and talk about how we, look at different acquisitions for contracts, or we're looking for mergers. Some of the companies we work with are smaller, maybe they're social economic status companies that want to merge up. So Stu could probably highlight some of those examples.
Yeah, so there's a number of things that we potentially look at. So,
Okay.
Tom, dealing with what you mentioned relative to putting some companies together. So one of the things that we do when we go in and we initially look at a company, we evaluate the strategic alternatives for that particular owner relative to their ability to monetize the business today or downstream. And as we go through that evaluation process, one of the things that we look at is, are they ripe for strategic merger? So in other words, is there an opportunity for a company to merge with a similar company or to merge with a company that has complementary capabilities to then position for downstream sales? So the 1 + 1 = 3 type of scenario.
Gotcha.
So that could be a viable alternative for the particular company. Some companies are a little bit harder to transfer, to Tom's point. So many times when you're dealing within the government contracting space, you may deal with a company that has set aside contracts or specific contracts that were provided to them by the government allocating certain dollars for businesses like them. It could be a hub zone company, it could be a small business, woman-owned business, and so forth. So understanding who their potential partners are relative to acquisition and so forth is really key. And we lean heavily on people like Wright to kind of come in and help us out with a review of those contracts to understand the transferability issues around them, or the potential issues around the transferability of those contracts.
So for example, if it was an SDVOSB or an 8A, they could lose status if the ownership flips beyond 51%, or if their revenue is too high, they could lose under their NAICS code that they're contracting for, they could lose their small status.
That's
So I guess
right.
you have to look at ramp. Yeah.
That's exactly right. I mean, some of those contracts you get run out. There's some rules out there today for mentor protege JVs, for instance, that if they come into play may limit the downstream sellability of those contracts. But so again, we lean heavily on attorneys like Wright to be able to provide us with the guidance there.
One thing about SD Capital that I found really interesting when I first was introduced to Tom and Stu was sort of their model on how they go about this. And I know you guys spend a lot of time with certain clients early on doing what I would generally kind of refer to as kind of management consulting type work to help these these business owners maximize enterprise value. What are some of the most common or the key levers? I know every business is different and everybody has their own issues, but what are some things that some levers owners can pull to maximize enterprise value on exit?
And one of the things that we really focus heavy on, or we see often, is when we walk into these companies, having a very clear strategy and growth strategy, go-to-market strategy, a lot of times in the evolution of a business, you'll go after anything and everything, and revenue is not all the same. So, looking at their contribution margin by revenue source, being deep and narrow as opposed to thin and wide, especially at a smaller size company, is often more attractive to a buyer, because it's hard for them, the smaller companies to compete with the large companies with that horizontal kind of model. So we look at heavy at their, the processes, procedures. Do they have, tools in place that are scalable, such as a CRM, where you can track the opportunities, you can track whether they're going through the stage gates with the P wins and having a breadcrumb trail to prove out there's evidence that they're going after things deliberately as opposed to, catch as catch can. That's an example. Steve may want to highlight on the back office where we see a lot of challenges, specifically on the lack of a traditional or seasoned CFO.
And so a lot of times when we go in, the other thing that we do more broadly as well is take a look at the entire management team. I mean, we're really leveraging our knowledge of the PE space plus our knowledge of questions that buyers will ask in the transactions. So, where are there potential holes? Where can the company be discounted? Do they not have an ERP? Do they not follow GAAP, for instance? That can be an issue that periodically comes up. Taking a look at all of that across the back office. Do they have the appropriate skill sets in place? Can we potentially position them as a platform company? In other words, a company on which you can bolt additional businesses, or are they more better positioned as a bolt-on acquisition for a potential buyer? So a lot of this analysis we look at up front, and then can we position a company that's really a bolt-on today to being a platform downstream, which we've done in the past, and that garners a significantly greater valuation upon sale.
So let me ask that, since you mentioned valuation, a lot of the question I get when people come to me initially before I send them to Wright are like, hey, I want to sell my business. I think it's worth $50 million. And I know maybe it is, maybe it isn't, maybe it's worth $100 million. What do you tell folks, and how do you arrive at a valuation that makes sense? And how do you communicate? And I'm asking a lot of compound question like crazy, but how do you communicate that to business owners?
Yeah, I think I'd start by first telling them there's 3 stages of value, and then we can get into some of the technical conversation. The 3 stages of value, it's pre-transaction value, the material things we can do to increase enterprise value, which is traditionally what buyers are looking for, and EBITDA, which is a proxy for cash. There's also the intra-transaction, which is the competitive process, and that competitive process, if done right, with the right, a controlled auction, let's say, it's gonna help increase that transaction value. And lastly, critically important too, is the post-transaction value. You want to hold on to what you're going to get. So there's tax strategies, estate planning, et cetera, wealth management and investment strategies. So 3 stages of value. So again, the earlier we get involved, the better it is. And, we can help, create value through those processes as well as protect value. And Stu, talk a little bit about what we call the country club multiples versus kind of what really drives the multiple in greater detail.
Yeah, because people do say, oh, it's 1.2 trailing gross revenue or 2x. I hear that all the time. That's industry standard. And then I start laughing, and I want to hear about that. Tell me why. I mean, I think it's kind of funny too, but I have no idea why.
Now, many times you sit down with an owner and they say, hey, I heard from a buddy that they sold their business for 10 times EBITDA or 10 times trailing 12 months EBITDA or some metric along that. So part of what we do, and Wright mentioned this, we have a very distinct process. In the beginning, we kind of do an assessment of the company. And part of that assessment is providing them with an indication of value. And we go through an approach where we kind of we take a look at EBITDA based on the information that we may have, and we provide this indication of value. And that's typically a range of values. So a multiple of EBITDA, can vary based on the individual market segment that a company's in, but we typically have enough information to provide that range of value. And many times that range of value may be a little bit different than what an owner had in mind, but it's important that we kind of ground them, so to speak. Right. Because again, those country club multiples, those values that are flying around, they may be great for one particular company. They may have no relevance at all for another. So we look at particular value drivers for a particular business based on their particular market segment. It could be the nature of the contracts they have. Tom mentioned the nature of the revenue that they have. It could be profitability. It could be cash flow. It could be IP. So there's particular drivers that adhere to all companies, and then there are drivers that pertain to specific industries as well.
Yeah, no, the size of the company is important, with the type of revenue, whether it's one-time revenue, recurring revenue, whether it's professional services versus managed services, how the buyer is going to come in. Most likely they're going to do a blended multiple based on the revenue stream, the contribution margin. So we look at and analyze all of those components to try to determine how we can tweak things to get the most value in the transaction. What's critically important too, working with you and the team is, we come from a technical background. So when we look at technical due diligence or operational due diligence, do they really own the IP? What vendors are they using? Are there, is there language in the contracts that could tripwire, let's say, a transaction downstream because they think they own code when essentially they don't own the code? Having, your team involved in looking at that IP and ownership of the IP as well as the contracts is critical to try to get, well out in front of so that you don't have that problem downstream.
Our ultimate goal is to improve that turn on EBITDA, so we can get additional multiples. So even if we go from like a 3 to 4 multiple on an EBITDA of, let's say, $3 million, that's $3 million that the owner gets, hopefully, to put the majority of that into their pockets. So our total goal is to create value for that owner for that downstream monetization event.
One of the things you just said about, for example, we used to get this all the time. Let's look at your source code. Do you really own it? Did you use a JPL license or whatever? Did you use these open source licenses that mean you really don't own what's in there and you have to rewrite code? Bigger question though, these days, are you worried about, or do you ask owners, or how do you deal with AI? Because the Copyright Office has said, this is kind of my space, but they said if you use AI to write source code, which everybody's doing now because it's fantastic and it works, you don't own whatever the AI outputs. Nobody owns it. AI doesn't own it. You don't own it. It's public domain, but it's not subject to any of the traditional licenses. So what are you guys doing? Where do you see AI coming into this? And I know it's a weird question for guys in the capital space, but it's hitting everything. And that's one example of where it might affect you. But how are you dealing with that? Or not that specific issue, but AI generally. Do you see it in other places?
Yeah, we see AI everywhere. I mean, it's we rely heavily on you for the legal view and opinion, but certainly, I think every company, you're either going to get left behind or you better start using it in some, fashion, whether it's generative AI or, predictive or prescriptive, and writing code and the algorithms for the code, kind of manipulating what you're getting. So you can use it as a base platform to create the construct or the framework, but then you have to put your own sprinkling of the creativity, I think, on that to really have true ownership. And again, I'm deferring to, your expertise on that, but every company we're running into in some form or fashion is using AI at its most basic element, whether they're using ChatGPT or Grammarly or something like that. And more advanced on the tech side is they're actually using it to write code and put, RPA and ML in place.
This is something I heard today, Tom and Stu, from a CEO of a company that's been around for 20 years. And he said it's putting out fires, it's hand-to-hand combat, because he is in the cell phone space, SIM, all of this kind of stuff. But he literally said to me, we're in Silicon Valley and we're not AI, and it's not sexy, and there's just no money if you're not AI. And I'm just wondering, is that true, or how true is that? I mean, do you have to incorporate some kind of AI as part of your base IP of yours? Not whether you're just employing it, but does it need to be part of what you have as a company to be sexy or interesting? And again, this came from somebody specifically in Silicon Valley, and he's competing in a space where they are. But I heard this morning, and it seems like you guys might know.
No, I would say it's exactly the opposite. I mean, again, in the deal thesis of the buyer, if they look at that technology and they can do something with it, let's say it's the base platform of the cellular technology or whatever he's doing. If I'm a buyer, specifically, if I have the capability set that I could put AI on that, then that's part of my deal thesis, right? So it becomes highly attractive to me because it's an opportunity for me as a buyer to do something with that.
can you guys give me like 3 or 4 things, like the main things that any business owner who's looking to sell their company should know or remember, like 3 highlight points where you're like, do this, this, and don't do this, or whatever it is? Are there things that you just say that are like your kind of elevator speech to business owners?
Yeah, so I would say without a doubt, and Stu, jump in here on the do's. I'm going to say the do nots, right? So absolutely do not try to juice up your EBITDA, because if you do, a buyer's going to see right through it. So quick example of that: if I do certain things and cut costs to try to ratchet up my EBITDA, thinking I'm going to get a higher multiple on sale, buyers typically come in and say, "Why did you cut the cost?" Because you cut those costs, I now need to make an investment. If I make that investment, I'm going to have to reduce the purchase price. Second thing I would tell them is never anticipate who your buyer is. That's a huge mistake, because somebody who wants to get into your space may pay a premium versus the ones who you think want your company. Those are critical mistakes that buyers, or I'm sorry, owners make. And Stu, some of the things that they absolutely should do well in advance of a sale, I think you can cover down on a couple of those.
Well, I'll hit one that kind of relates to the first one that you mentioned, and that is run your business as if you're not selling it. So that goes with Tom's about creating artificial EBITDA. So you definitely want to be, from a decision-making standpoint, as if you're continually running your business. The other is, there are certain key artifacts that you need to have in place that all come down to the same things that you need to have a well-run business. So whether you're selling your business or not selling your business, having good financial statements, going through having the process and procedures in place. Those are just good business practices, and that should run your business either way. And then the last one I would point out is have a plan for the next stage of your life. So many owners want to sell their business. They sell their business and they're empty. I mean, the regrets can be high. So really have an understanding of what you want to do. And then I will throw one more on top, and that is understand who your key people are and how you want to reward them when you go through the sale process.
Pulled out 5 essential things, it sounds like. So number 1 is run your business like you're not selling it. That's kind of, and that's part and parcel of don't pump up your EBITDA, by cutting costs, that kind of thing. And then number 2 is don't anticipate your buyer, I guess, mentally or whatever it is in your space, because that is something. Talk to a lot of businesses. Yeah, we're in diagnostics. We're only looking at, diagnostics companies. So maybe there's maybe there's value there like that. And then your third one was have a plan for after. And maybe that's your fourth one. Your third one is know who your key people are and how you want to reward them. And I guess that plays into whether they're staying in the business as it transfers and you need them and they're valuable, or whether you need to kind of buy them out and reward them for their career. And then the fourth one you had is have a plan for afterwards. So you don't go crazy. Like my dad, when he left Arthur Andersen, retired at 55, he started buying old houses and doing carpentry. And he was a CPA with an MBA from Columbia. And it lasted like 2 or 3 years. And he's like, this is hard. And he kind of quit. And he actually hired a carpenter to do the thing he thought he was going to do. So yeah, I love that. So that's right on point. Right. Do you have anything to add to that?
Yeah, I could just chime in on one of those pieces, which is when especially if you're planning on trying to get a second bite of the apple, or if there's any kind of, earnout or contingent consideration in your transaction, making sure that your key people are rewarded for staying and helping you make that earnout is a huge way to make yourself and them very happy. So, you want to put something in place, some sort of a phantom equity or changing control type bonus, which is also contingent on essentially either them sticking around or them, continuing to be employed by the buyer, or, hitting certain metrics, or however you want to do that. But there's some creative ways to help everybody win in that situation.
Awesome. That's fantastic. Tom, Stu, Wright, thank you guys so much. I think this is super helpful. And if people want to reach out to you, what's the best way? Do you guys have a website that's accessible? I know you're part of a bigger organization, but does ST Capital have its own place for you to We'll drop a link to your site in this podcast, but if people are listening, what's the domain?
Yeah, the best place to reach us would be SchneiderDownsCapital.com.
Okay, SchneiderDownsCapital.com. Perfect. And watch us on YouTube. Download us wherever you get your podcasts, Spotify, iHeartRadio, all of those things. Thanks for joining us for another episode in season 11 of the BlackLetter Podcast. We'll see you next time.